Ahoy there, trader, and welcome back. This is the Anti-Investor Swing Trading Podcast. So let's talk about the Cobra Effect and trading. As is often the case, history can teach us a lot about the future, especially when it comes to trading and the innovative ways that people can try and game the system. So what do rats, cobras, and sparrows have in common? And what on earth does it have to do with trading? So in this week's podcast, we reveal some of the interesting lessons from history that show why not planning for the future can have some serious repercussions and some unexpected outcomes. So let's take a trip down memory lane, have a skip through history, and see how having a cunning plan can have some not so amazing results, and you could possibly even make things worse than they are right now. Welcome to the Anti-Investor Swing Trading Podcast, where we talk about swing trading stocks, stock options, and index futures. My goal is to give you the right tools, the correct rules, some software to assist you, a community to support you, and if you'll allow me, to be a mentor to show you the right way so that you get real results in the fastest and smartest possible way. So as the famous poet Blackadder once said,
I've got a plan so cunning you could put a tail on it and call it a weasel.
now history has sightings full of cunning and ingenious plans, but are they really as cunning so as not to be outfoxed as they think they are? So let's look at Exhibit A, the Cobra Effect. Now this time the year is 1858. The British colonial rule of India has started, and there's a problem. Long, thin, hissing things that bite and spit venom, also known as the cobra, seem to be a problem, and people were quite literally dropping like flies. Not to worry though, let's insert our own Blackadder-esque cunning plan. The British have a rather cunning plan. A plan so ingenious, you could pin a tail on it and call it a weasel. The solution was to put a bounty out for every cobra head. And this seemed like a very simple and self-regulating solution. So the local populace hunt for cobras, and the British pay per head for the bounty. And with a wry grin, all is good so far. And just like that, the problem is managed, if not quite solved. And we can quite literally be home for tea and biscuits by 5 p.m. That wasn't until about 5:05 when the locals looked at each other and arched an even more evil and scheming plan of their own and said to themselves, hang on a moment, we can breed the cobras for the bounty, thus outfoxing the weasels with an even more cunning plan. But once again, it was only briefly, as the British, being more cunning, outfoxed the foxes with their own devilish response, and with a wry grin on their face decided to offer no more bounty for the cobras. And that was when all the captively bred cobras were quite literally released into the wild, making the cobra problem 100 times worse, probably even 1,000 times worse than when they started with. So it's not a very well thought out plan, but as if history couldn't teach us any more about this, it gets better. And as we know, history does have a way of repeating itself. When the French this time had a rat problem in Vietnam in 1902, they similarly offered the locals a bounty for rat tails to solve the problem, which, as you can see, the theme led to increased sightings of rats with no tails, as they would quite literally just chop them off and then release them back in the wild so that they could continue to breed and collect the bounty. Oh, but wait, there's more. The Chinese in 1958 started a 4-pest campaign. They were trying to get rid of sparrows, mosquitoes, flies, and rodents, and they were all targeted as a way to stop the spread of disease. Now, as it turns out, only the sparrows were wiped out, leaving no natural predators for the flies and the mosquitoes, thus pouring fire on the flames of widespread infection, which led to massive crop failures. And this is, if you look through history, is known as the Great Chinese Famine. And there are so many simple solutions to big problems that have far-reaching and many times negative impacts on the problem that they were trying to fix. Now, unsurprisingly, trading is no different. we can draw lessons from stupid ideas. And how many times have we often thought to ourselves, I'll just widen my stop loss, thus not being stopped out, but only to end up being stopped out for a bigger loss than what you should have done. Don't move your stop loss. And more importantly, use a stop loss. So many people don't use them. Have a defined risk, an acceptable loss, that's the point where you're proven wrong. Don't pour water, don't pour fuel on the fires of something that's going wrong. That's your eject button for the trade. Okay, it's not going right, let's close the trade. But similarly, don't have it so tight as to always be stopped out, and then you end up waving goodbye to a successful trade from the sideline. So a sensible stop loss is necessary. Now, adding onto a trade that's not moving is another off-the-cuff plan that many new traders do. And all that's really happening is you're doubling down on your risk on a trade that is dead. It's not going anywhere. It's not being stopped out, but neither is it moving favorably. And this is often the result of boredom. You can quite literally place trades because it's not going anywhere, and adding to the position is not going to make it do anything more. And quite often you'll see that trade get stopped out anyway, so you take a double loss instead of a single loss that was previously acceptable. Now, similarly, averaging down. Do I really need to explain this one? If you could see me now, you would notice a quite literal hard eye roll that I'm giving the microphone. Define your risk. If it's not going your way, and this is for the no stop loss people, if it's not going your way, adding to a losing position is never a good idea. You're not getting a better price. And sure, it may work from time to time, but the reality is, time to time doesn't pay the bills. So if it's not going your way, get out. Add to winners. Adding to losers doesn't make sense. Similarly, forcing trades, popping a trade on to see what happens. This is for the no plan people. It's just, again, driven by boredom, the desire to trade, the need to trade, the urge to trade. And the reality is, as traders, we get paid to waiting for the opportunity, waiting for the trade conditions to set up, waiting for the time to be right, as defined by a well thought out, proven, time tested, back tested, forward tested, sideways tested, real time traded trading plan. So pop and trade on to see what happens. That's not a plan. Use a plan. Have a plan. Most people don't have one, and wonder why that this trading thing doesn't work like it was described to me in the pamphlets. It's a silly little thing, but all successful businesses have a plan, a nice robust plan of action. Now, for me, I often talk about trigger bars in my trading. I want a very definitive trigger to take action. Most of my traders use, 90% of the time actually, all my traders use some sort of trigger so that we can definitively, at the point of entry, that was the point of entry. So we're not guessing on when we should or shouldn't be in a trade idea. So at the time of the trade, we can definitively say, I should be in there. Now, the rest of the time, there is that 10% of the time, it's a little bit price action. Well, it's not a little bit, it is price action based. So it requires a little bit of chart reading for the more intermediate chart readers. Again, the trigger bars are, to be fair, that's what I use most of the time anyway, but it just means that I don't have to be at the screen reading the chart, reading price action, and I can step away and do other things. So there's price action entries or trigger bars. Now, it's not the only trade criteria. An entry condition is not a strategy, which is what most people think. It's the crossovers, the MACDs, the CCI extremes, or the crossovers, or the hooks, or the RSIs, again, extremes, hooks, whatever the tool that you're using. The entry condition is not a strategy, which is what the textbooks would have you believe. So you need entry conditions, exit conditions, trade management conditions, position sizing. What are you going to do if it doesn't go to targets, but has a profitable outcome? You're not going to let a profit go into loss. All those things need to be considered, and it can be a simple one-sheet trading plan. I like simplicity. But ultimately, you need to control the decision track that you're having. I refer to what I do as a production line. I want to go step 1, step 2, step 3, step 4, place the trade, and then for trade management, guess what? Step 1, step 2, step 3, step 4. It's either going to be this or that. If this, then that. I like to think of it like an algorithm, but it's, to continue with the metaphor, it's a production line. I'm going to chug my trade along the raw materials of the factory conditions to placing the trade and successfully managing the trade. So I know what I'm doing, when I'm doing it, why I'm doing it at every juncture of the trade. So stick to a plan, otherwise you're going to get bitten by that cobra. Now the bottom line, as you probably gathered, is you need a plan, but not just any plan, but a well thought out plan that is time tested and proven. Now there's some great softwares out there these days that will allow you to plug in a non-programming strategy, if this then that. There's some great tools out there that are inexpensive. I personally use TradeStation. It was one of the few choices that we had 25 or so years ago. But it allows me to codify what I'm doing. That algorithm that I mentioned, the if this then that, when this condition happens, do this, or if that happens, it's a decision tree. So I can put that into the software at the click of a button, prove that if I just, for example, bought the dips and sold the rallies and did nothing else, didn't really think about who was tweeting or what the economic reports were, should I or could I have made a profit on the S&P 500, for example, or if I was day trading, the same thing. If I was swing trading, the same thing. If I follow this process, do I have the opportunity to consistently make money without really thinking too hard? And what we should be able to see is visually plot over 5, 10, 15, 20-year period of data that we have and see a nice steady equity curve. That's a time-tested and proven strategy. And again, I've got the real-time results to back that up as well. So the point is you can demonstrate to yourself any trade idea that you want before you place real money, your hard-earned cash, on the line. Now, a plan, it can be as simple. Now, that's the way I like it. Again, I refer to what I do as a production line for a reason. It's a simple set of rules that I just follow. But it does need to be well defined with precision. Again, for example, most novice traders attempt to buy the dip, as you heard me mention a moment ago. But a down day or a down week or a down month, does that really mean that it should be bought? Just because a stock price is moving down doesn't mean it's good value at a discount, as Warren Buffett might say. So for me, a dip needs to be in context of the trend. And it's a simple little addition, but so many people don't look at the trend. We want to see an uptrend over a 12 or a 15-month period, or if you're looking at intraday charts, you want to see a trend over 200 to 300 bars, depends on the time frame that you're looking at. You want to see a nice steady uptrend so that you can confidently buy the dip in the context of a trend. And then we're just waiting for those trigger points that I mentioned earlier to go, now's the time. Trade on, stops in, target sets, and then for me, I don't, have very little to do between stops or targets being reached. Now, I do this no matter whether I'm day trading, short-term swing trading. My idea is I want to get paid at the end of the day, the week, the month or the quarter if I'm swing trading stocks. So again, day trading futures, short-term swing trading on futures and stocks, and monthly swings on usually stocks using stock options. That's what I prefer to do. But in each and every case, I'm waiting for the right conditions. So a lot of my time is spent waiting, just waiting for the right opportunities to present themselves. And that's what you need to do. You need to wait for the right conditions. It is paramount. Otherwise, you'll just end up being bitten by a big asp snake problem. So if you like what you've heard today, be sure to follow and listen to the very first episode where I map out one of my 6 money-making strategies. Actually 8 now since I first started this podcast. There's 8 money-making strategies that I use on a regular basis. Now, if you have questions or want to plug into a proven production line process after you've gone and listened to the first few episodes, I get together with a few traders a few times a week that plug into this exact process. The system takes just 20 to 30 minutes a day, regardless of whether you're day trading, swing trading, or every other day. If you're swing trading, actually, you can just check in once or twice a week. But it is a proven rule-based system that is repeatable, which is the key component. And if you'd like to join us, let's just start the conversation. I don't know if what I do is right for you. Phil@antivestor.com, shoot me a message, and let's just have that conversation. I've always got time with serious traders, and if what I do isn't right for you, then I'll at the very least point you off in the right direction for what you are looking for based on your unique and specific set of circumstances. And if it does make sense, if you want to, we can hop on a call. I'll talk through your situation for you. So, right then, there's only one thing left to say, and that's to say thank you for giving me your time and attention. Have a wonderful day, and I'll speak to you at the same time next time. Toodaloo, trader, and bye for now. Keep in mind that futures, options on futures, stocks and stock option trading involves a degree of risk that may not be suitable for all investors. Past performance is no guarantee of future performance. Anti-Investor provides educational information and does not provide financial advice.